Hello everybody, it's this Tortoise Investing coming at you today with 3 railroad stocks you can buy and hold forever. The best 3 that are out there right now. These are on sale, I personally feel, and I was just wanting to bring them to you. Not financial advice. Always do your own research and stuff before buying anything. And very quickly, before we jump into things, please hit that subscribe button. Please hit that like button. Stick with me here. Comment down below. All these things help a ton, makes the YouTube algorithm happy, makes me happy. Now, the portfolio, just go very, very quickly show us to yins. I don't plan on ever having this hidden from yins. Just full transparency, show you how I'm doing, my ups, my downs, my all-arounds. Year to date, we're looking at 15.3% up. The market is up 11.26%, so we are still beating the market. We take a look at the holdings tab here. We are down in quite a few positions, but that's fine by me. I get paid on Friday. I'm honestly hoping these stick where they are. I'd love to add to all of these. United Health Group, it's carrying a portfolio. It's got the portfolio on its back. But yeah, this is how everything's looking. I might have jumped into Hershey a little soon, but you know what? I was perfectly fine jumping into 220s. It's now below 200. Hopefully I can add more. Same thing with Extra Space Storage, Texas Roadhouse. Very happy with my portfolio, and I just intend to add and add as time goes on. I might add a new position on Friday if I find something that I really like, and if not, I'm just going to DCA down in these. Now, without further ado, the 3 railroad stocks we're going to taking a look at. We got Union Pacific, we got Canadian National Railway, and we have Canadian Pacific Railway. Now, Union Pacific has adjusted free cash flow yield of 4.55%, dividend yield 2.55%, and a payout ratio of 47%. They are off a recent high of, around 238 down to 203, so that's a more than 10% drop. Revenue's been increasing slowly but steadily over the last 5 years at a rate of 3.21%. Cash flow's been increasing at a rate of 9% over the last 10 years. Look at that. They are generating oodles of cash. Very nice. EPS been increasing at a rate of 10.4% over the last 10 years. Very nice. Debt, they do have some debt, $31.6 billion. Their EBITDA is $12.5 billion. Falls in line with it's not 3 times their EBITDA in debt. If that would have been the case, it's usually a little bit of a red flag for me. But that's not always a red flag. Dividend's been increasing at a rate of 12.65% over the last 10 years, which is also very nice. And the thing I love about railroads, they usually do share buybacks, and this has been doing some hard buybacks over the last 10 years, a rate of 4%, 4.8% in the last 5 years. It's just right there in line, 4 to 5% buying back shares, and I love that. A lot of railroad companies will take on debt to do this, which, I mean, it's fine. Keep buying those shares back. Do it. Let's take a look here at the return on capital employed. This has pretty much been 13 plus for forever. I think the market average is around 9 or 10, which is here. So very nice. We're going to do something a little bit extra here. We're going to take a look at the gross margin, and operation margin, profit margin with these 3. So gross margin, also pretty good, above 35%. Operating margin right in line, and the profit margin is about 20% plus, and it's growing, which is very nice. So you've seen the revenue wasn't growing all that much, but the profit margin and everything else is growing, which is great. Now, next up, Canadian National Railway. This one I actually really like. Adjusted free cash flow yield 6.46%, dividend yield 2.14%, and payout ratio 42.7%. This one's kind of just been all over the place, up, down, up, down. The recent high was around 123 back in April. Now, the revenue for this one over the last 10 years, 5.6%. Over the last 5 years, right in line. Cash flow has been increasing at a rate of 11.41% over the last 10 years. Again, just really nice, up and to the right. EPS, 9.29% over the last 10 years. Debt, they have $14.37 billion in debt. Their EBITDA is $9.6 billion, which is another reason why I really like this one. This one's got a lot better balance sheet. They don't have as much debt. They are still trucking right along. The dividend's been increased at a rate of 10.96% over the last 10 years. So again, very nice. Shares outstanding, they've been buying back their shares at a rate of 2.38% over the last 10 years, 3% in the last year, taking advantage of those cheaper prices, which is awesome. Return on capital employed, let's take a look at it from 10-year chart. Very similar situation. Market's usually around 9 to 10. This is like right in line with, being above it, and it's growing. This was 11.5, 12.3, and a 14.6. It's growing. It's good. Return on margin, gross margin. Oh my god, I have kittens running around me. I'm sorry. Gross margin, 40% plus, very nice. Operating margin is 36, 34%. And so mid to upper 30s, again, very nice. And the profit margin as well is right in line with what you want to see, 25 to 30%. Very, very nice. Now, lastly, we got Canadian Pacific. This is a popular one in a lot of people's portfolios. This is a popular one in a lot of your big billionaire portfolios. I think Bill Ackman personally holds this one in his account. This has been off a recent high of 84 down to 72. So that's another, 10% drop. It says they have an adjusted cash flow yield that's negative. That they do not. So dividend yield 0.76%, payout ratio 22.75%, revenue's been increased at a rate of 4.46% over the last 10 years. Free cash flow has been increased at a rate of a lot, 30% over the last 10 years. Very nice. EPS 21% over the last 10 years. Some nice growth. Now this one does carry a little bit more debt than what I would like, but you know what? They just had this big acquisition go through and everything. So maybe that's something they're going to start chopping at. Their EBITDA is 5.65 billion. Their debt is 17 billion. So it is a little bit over 3 times, but we will give it a pass for right now. It's not outrageous, not like 5-6 times. Dividends been increased at a rate of 7.57% over the last 10 years. And they were buying back their shares, and then they had that acquisition happen, which should help them in the long run. They just acquired, I think it was like Kansas City Railroad, and they're gonna have like a CPK something, change up their ticker symbol. Or I thought I seen that somewhere. Return on capital employed. Take a look here at the 10-year. It's, not too bad, around 15 percentages. 2021 they had a dip, and then they had this dip in 2022. But the reason that this dip probably occurred was they issued more shares, and that's going to make your return on capital employed go down. But their gross margin, 40% plus, operating margin, 40% plus, and profit margin, just 30 to 40%. Trucking right along. All of these have great gross margins, great profit margins, and great return on capital employed. And they usually buy back shares. They got a good dividend growth history. I like them. Might be something you just want to look into, especially because they're all down off this recent chaos that is in the market right now. Always do your own research and stuff. I hope you enjoyed that. As always, make sure to hit that like and subscribe button for more. And until next time, see yins.